The relationship between money and trust. Money and trust are deeply interconnected in both personal and societal contexts. While money is a tool for transactions and wealth accumulation, trust determines how people use, share, and manage it. Without trust, money loses much of its effectiveness in social, economic, and personal interactions. Researchers in economics, psychology, and sociology emphasize that trust is a crucial factor in financial stability, cooperation, and long-term economic growth. 1. Money as a symbol of trust. Money itself is a social contract. Currency has value only because people trust that others will accept it in exchange for goods or services. This trust underpins the functioning of financial systems and markets. In modern economies, trust in banks, governments, and financial institutions ensures that money can circulate efficiently. When trust erodes, such as during banking crises or hyperinflation, the value of money and the willingness to engage in transactions decline sharply. 2. Trust in personal finance. At the individual level, trust affects financial relationships. Trust in financial advisors or institutions influences investment and saving behavior. People are more likely to invest if they believe the advice or institution is reliable. Trust between individuals, such as lending money to friends or family, often depends on confidence in honesty, responsibility, and repayment. Lack of trust can prevent mutually beneficial financial arrangements. 3. Trust and economic behavior. Economic studies show that high-trust societies tend to have stronger economies. Trust reduces transaction costs, as people spend less time and resources verifying agreements or enforcing contracts. Conversely, low-trust environments often rely on legal safeguards, collateral, or higher interest rates, which can slow economic growth. Trust also affects consumer confidence. When people trust the financial system and institutions, they are more likely to spend, invest, and participate in markets. 4. Psychological aspects. Psychologically, money can influence trust in subtle ways. People may feel more secure and independent when they have financial resources, which can increase trust in themselves and others. Conversely, financial scarcity or stress can reduce trust, making people more suspicious or risk-averse in transactions. Wealth can also shift social dynamics. Unequal financial power may lead to distrust in personal relationships or workplace settings. 5. Building trust through money. Money can be used to build trust when managed transparently and responsibly. Honoring financial commitments and debts. Using money ethically in business and personal dealings. Creating financial systems with accountability and clear rules. Transparent and consistent behavior strengthens trust, while mismanagement or deceit undermines it. 6. Money, power, and trust. While money can facilitate trust, it can also challenge it. Wealth can create imbalances in relationships, leading to suspicion or jealousy. People may question motives in financial interactions, wondering whether actions are driven by generosity or self-interest. Balancing financial resources with honesty and transparency is therefore essential to maintain trust in both personal and societal contexts. Conclusion. Money and trust are mutually reinforcing. Money relies on trust to function effectively, and trust is influenced by how money is used and managed. At the societal level, trust underpins economic stability and growth, while at the personal level, trust determines the quality of financial relationships and decisions. Ultimately, responsible management of money, ethical behavior, and transparency are key to fostering trust in financial interactions, enabling both individual and collective financial well-being.